Hi guys, Tim Melvin here on Monday, June 20th. It's just kind of a low-key research-oriented day since the markets are closed for the Juneteenth holiday. We're just kind of kicking around, getting a little research and some work done. And just an absolutely wonderful Father's Day weekend down here. After a week of madness with the contractors in the house, we had all the floors replaced. That's always, just a big, exciting time. So they look great, but it was a very just, hectic week last week, so we didn't get a video to you. So I thought I'd pop in here Monday when there's not much going on, no deadlines, and nobody ripping stuff up. By the way, it's not going to last long because the insurance company has told me I have to put a new roof on here, and that starts the day after 4th of July. So that'll be another round of real big fun. Anyway, just read over the weekend an interview with Seth Klarman that he did with virtually with Harvard Business School last week, and he talked about uh, the need to remove the extremes when you're investing. You want to get out of that cycle where you're investing money at extreme highs or selling stocks at extreme lows. Now, we found that we've been able to really use the uh, high yield credit spreads in a very effective manner to help us do just exactly that. Ever since I had a conversation with Dan Rasmussen of Verdant Advisors and stole this theory from him in its entirety, we found that it works extremely well. When you get spreads that blow out much over 7.5%, it's time to be an aggressive buyer of risk assets. Then when it gets down to where it was for a good part of last year and into this year, and you're down around 3%, yeah, not a great time to be a buyer. Probably a good time to lighten up, get into some lower yielding, shorter term opportunities, or even hold cash, even when cash is not paying very much at all. So he also talked about something that's very important that you never hear talked about by financial advisors, the mainstream financial media, that type of thing. That is age really matters. We all hear the mantra, just buy and hold. You no matter what happens, the market eventually recovers. That's fine if you have time for the market to recover. For instance, this current bear market, if you're still in the accumulation phase of life, this you should be popping champagne corks and celebrating because I know that I am. I have no intention of retiring anytime soon. So we're still accumulating. And so I'm delighted to see this opportunity that's being created to buy risk assets at what I hope will continue to be greatly reduced valuations before too terribly much time goes by. Fortunes are born in bad markets, and this is shaping up with the potential to be a really bad market. However, if this was occurring when I was, I don't know, 70, 75 years old, and I was thinking of slowing down and beginning to take income off of my investments and use my net worth to fund a retirement, then what just happened is devastating because the markets have gotten hit hard. I've taken a serious loss. If I had a lot of my net worth in the markets, my net worth is now greatly reduced. Now, it may be offset somewhat by the very high housing levels, but there's a good chance housing takes a hit in price before too terribly much longer on the upper end of the marketplace, to be sure. He also talked about something that I will frequently talk about. Everything is a buy at a certain price. Everything is a sell at a certain price. And in between those two prices, most things are usually a hold. Charlie Munger has talked about this. One of his favorite companies is Costco. He bought it years ago at something I think he said 12 times earnings or so. Very easy decision to make to buy Costco at that price. He's not going to sell it today. It's a great company doing great things, performing very highly, but he wouldn't put any more money into it because now it's trading up around 30 times earnings. It's not at an excessive valuation like we saw in tech stocks during the late half of 2021, but it's not at a buy price either. So everything, the best company in the world has a sell price. The company that's maybe not so great and is kind of boring has a buy price. There's a price where it's cheap enough. That may be down below its liquidation value, but everything does have a buy price and a sell price, and that's worth keeping in mind because we tend to get caught up in themes and stories, and we'll overpay for things, paying hundreds of times earnings for companies or hundreds of times sales for companies, and no business is actually worth that much. Conversely, if prices keep falling, we're going to see some great companies trading for 10, 12 times cash flows, trading below asset value, below liquidation value. People are going to be afraid to buy them. It's going to be time to buy. When you see that your broker is puking in the garbage can under the desk during your meeting with him, it's time to be a buyer of stocks, guys. I know that because I was that broker once upon a time. So we're watching high yield credit spreads very carefully out there. It is ugly out there. It's going to get uglier. The S&P 500 is off 24%. NASDAQ's off more than 30. Most of your bank indexes are off about 25% or so. Now, our portfolio of small bank stocks that we have, well, that's off a whopping 2.5% so far this year. So it's holding up pretty good. So again, by the way, if you are an older investor, buying these smaller local bank stocks that have great dividend yields is a great way to meet your retirement needs because they have a fraction of the volatility of the larger dividend paying banks. So just food for thought there. Last week, guys, was just brutal, especially Friday. It was a sell everything. It didn't matter. They sold oil down 7-8%. That's insane. Oil being down makes absolutely no sense. We did not suddenly increase production or add refining capacity last Friday afternoon. And we're going into summer driving season. Demand's not going away. That's a foolish hope. These trips that folks are taking were planned, last year sometime. They're going to do the driving. People need to get from point A to point B. They're going to drive. They may have to go add a little extra to their credit card balance. They may have to dip into their savings. But summer driving season, I think, is still going to see higher demand for gasoline. Diesel fuel remains an issue across most of the United States. We're still in a shortage. Trucks still got to get stuff from point A to point B, folks. There's very little that you can buy in this world that does not have diesel somewhere in the supply chain. So that's actually very inflationary. High yield credit spreads we're starting to blow out, guys. We're at 5.17% last week. 6% is the level where actually Mr. Rasmussen did a special risk-on fund when spreads went over 6% in 2020, and he lifted them back off when spreads got back down under about got that around the 3.5% level. In the interim, he used leveraged small cap equities to pull that off. Had an 84% return for the institutional investors that put money into that. I think that's an outstanding strategy and approach to the world. We've certainly got it in our tool bag and are hoping to use it going forward. Now, it took, guys, to give you some idea of where we are, okay? It took a 25% down move to get one standard deviation above the 10-year mean for high yield credit spreads. 7.5% level is roughly 2 standard deviations. So the question in my mind is, how much more of a drop do we have to take to get there? Could be a long way to go. The yield curve, when I look at that, that's my other kind of advisor on the macro stuff, because left on my own, I'll make a mess of it macro. But if I just learn how to read these 2 key points, I won't get myself in too much trouble anyway with these 2 key indicators. They see a recession next year, not this year. I agree. So do 86% of the bank CFOs. Now, keep in mind, these are the CFOs, the numbers guys. They're not the big vision guys. They know everything that's going on with the bank, what their customers are doing, what the loan book looks like. They're saying, yeah, we're probably going to see a recession next year. They agree with me. So as a group, that's just a highly intelligent group of folks who also, most of them see it in the first half of the year. That's like 66%, another 20% think in the second half of the year. I was originally second half of the year, but I might be moving that up just because we are starting to see some things slow. But I don't think we'll get an official recession this year. Consumer sentiment is truly horrible. I saw the same chart from University of Michigan. Everybody else did. I've heard some of the other discussions. But I look at rail car shipments, and they're still really high. They're down from last year. Really? They're down a couple percent from last year. Last year was the all-time high for rail shipments. So if we're a little bit off all-time highs, I think we're still pretty good. Consumer spending still pretty good. Auto spending starting to come back. Still supply-demand problem there with the whole semiconductor thing. But credit card balances are going up. Savings accounts balances are coming down. Like I said, employment's still pretty good. So I think we're a good 6 to 9 months away from a recession setting in here in the United States. Um, they're going to keep having to raise rates. They don't have a choice. Will it be 50 or 75 basis points? I don't know. Um, to get inflation from 8.6% back under 2% is a job. Okay, that was a George Washington University economist. I'm going to go back here in my notes real quick just to get her name, because she deserves credit for this, because what she came up with was pretty smart. Diana Furchtgott Roth, and I hope I said that right. But she pointed out, got an email from her department this week. She pointed out that there's never been a time when the Fed was able to get inflation under control when the interest rate was not above the inflation rate. Guys, the inflation rate is 8.6%. Rates going that high would be devastating. Hopefully they cross somewhere in the middle on the way up. But at some point, in order to tame inflation, get it back under 2%, interest rates are going to have to be higher than inflation. We'll see what it takes to get there. It's going to be a lot. It's not going to be fun. And I don't think the broader market and the larger cap growth stocks are going to like this very much at all. Now, here comes the challenge and why Jerome Powell truly has the very worst $200,000 a year job in the world today. Once we get inflation under control, he almost has to cause a recession. So he's got an excuse to bring inflation back down. To bring interest rates back down. According to Bloomberg, did a little research on this over the weekend. When interest rates were averaging 1.4% across all ranges of the federal deficit, interest expense was about 9% of the federal budget. I think this number's for 2021 or 2020. I'd have to go back and check it. But recently, okay, with 1.4% average interest rate, we had 9% of the federal budget was dedicated towards debt service. Guys, if we go to the Fed's target of 3.4 by the end of the year, okay, now we're going to be a little over 20% of the federal budget going towards servicing the debt. If, as we did in 2007, we go to a 5% Fed funds rate, guys, we're in deep trouble. That's 33% of the national debt going just on debt service. Now think of the interest rate. Forget principal, guys, here, okay? Just the interest rate on your credit card debt and your mortgage and your car loan. We're eating up 1/3 of your available budget. You would be in deep trouble. Should we have a sustained period of time of that in the United States? Yeah, we'd be in something very similar to that. It would be ugly. So it's all going to be a very tricky time going forward. The markets are going to be quite volatile. Eventually, the market will look forward to a recovery from all of this, but we're not there yet. I think there's a little bit, maybe even a lot more downside left to this. We'll change our tune and get more wildly bullish when we get to 7.5%. Now, there's going to be bear market rallies along the way. Stocks right now are very oversold. Now, they're not to the, oh my God, very dramatically oversold level, but they're very oversold. About 15% of all U.S. stocks in the S&P 500 are trading above their 50-day moving average. So that's not too far off of where markets have put in at least minor bottoms in the past. Bear market rallies tend to be rip your face off, quick, fast, very painful rallies. This is just to spread the pain around, to make sure that the shorts aren't just having a huge party all the time. The market likes to wound as many people as possible on any given day. So we're going to see some rip your face off rallies. And if we find an opportunity to do something there, we will. It's not really my strong suit. I don't think it's over, I guess, is my message, guys. This has been very orderly. It's been on script for the entire sell-off. Higher rates were going to sell off, and it's just exactly what happened. We haven't Friday, I think I felt the first kind of pang of, oh, wow, real fear from people. And you saw it in the fact that they were selling everything, commodities, energy, REITs. It didn't matter what it was. They would just get me out. I'm dumping right here, right now. That was the first kind of strong whiff of pain that I've seen so far this year. I think we need to see a lot more of that before you can say, yep, bottom is getting really close here. Now, income investing has been tough all year, and mortgage REITs have just been hammered. And again, right on script, right? rising rates are really not great. They, make the value of the mortgages held worth that much less. Book values take a hit. But now, guys, mortgage REITs, the spreads between what these REITs can borrow money at and what they're earning on the securities, it's out at historical highs. It's like two standard deviations away from the norm, I believe I read in one research report. And we're starting to see insiders step up to the plate with 6 and 7 figure buys of the shares of the REITs that they run. These guys have been in the business a while. They've seen panics, they've seen rallies, they kind of got a feel for what's happening in the market. And when you see them writing really large checks, especially the top executives, you start to get a feeling that their attitude is, look, there may be some more short-term pain in here, but just in case we're going to rebound from these levels, the return opportunities are so massive. I want to meaningfully increase my stake in shares of this REIT that I'm managing. That's certainly the case over at industry leader Annaly Mortgage, the symbol's NLY. They're kind of the big daddy of residential mortgage REITs, and they've been, again, on script. They're off 30% this year. Book values have been deeply compressed. The Fed's exit from the mortgage security business, fears of that going on, are also, bringing some sellers in because you've got the Fed's going to stop buying at a minimum. They might not actively sell, but they're not going to roll over their maturities anymore either. They're shrinking the balance sheet and cutting back on their holdings of mortgage-backed securities is a big part of that. They're going to start it, I think it was $15 billion a month, and then reduce reinvestment by $35 billion a month until they, pretty much have eliminated a significant portion of that portfolio. Large buyer has come out of the market, and that's got folks a little scared. Now, here's the thing. The spreads are blown out to historic levels. Thanks to 2020, most of the mortgage REITs have cut way back on leverage. They're nowhere near as leveraged as they have been historically. And most of them kind of had a feel that, look, all of that stimulus coming in at a time that we were going to be reopening the economy in 2021 was going to create inflation. We were overdue, and that was probably going to put some pressure on pricing and interest rates. So they had reduced leverage quite a bit. Now, guys, look, you're going to take the largest buyer out of the market. Okay. It may not be a seller, but he's not a buyer anymore. And that's the United States government. There's going to be a need for private capital to step up. Now, with spreads at historic levels, it's going to be possible for these guys to come in, buy up enormous amounts of paper at very attractive yields compared to their borrowing costs. And again, locking in that massive spread between borrowing costs and investment yields, and using that to grow their payout. Keep in mind, Annaly Mortgage is already yielding 16%. That could actually go higher. It's also trading at a big discount to the value, even the depressed value of the mortgages that they own. So there's probably something on the order of 20 to 25% upside in the price as it trades back towards asset value. So I think at this price, it represents something of a low risk yield opportunity with spreads already out 2 standard deviations. I'd be shocked to see a third. The CEO of the company certainly appears to agree, already owns a lot of stock. He just spent $1 million to buy a whole lot more. So he's got more exposure to the recovery rally in mortgage REITs that he thinks is going to start happening sooner rather than later. So 16%, you can lock that in with upside potential. I think you've got to add at least a little bit of that to an alternative income portfolio. Dynex Capital DX, we're seeing the same thing, impacted by the exact same circumstances. Trade at 79% of book. So again, 25% upside there back to asset value, 10.71% yield. And we've had the CEO there. He hasn't quite crossed the 7-figure mark in the last month, but he's really close. He's in the way high 6 figures, adding to the position in the mortgage REIT that he oversees. So insiders, they may tend to be a little bit early, but guys, 10.71% and 16% on the other. Those yields are covered by cash flows. I'm not saying that I'm at a point where I'd be comfortable, taking out a mortgage on the house to buy mortgage-backed securities through these REITs, but they have a place in an alternative income portfolio. They're producing a lot of cash, and there's substantial upside. They're not structured a lot differently than many of our banks. They're taking in deposits or borrowing money at a low rate and reinvesting it at higher rates, primarily in agency backed residential mortgage securities. So I like the setup I'm seeing. I'm a big fan of the insider buying that I'm seeing in that. Not saying they can't go lower first, but I think 2 years from now, you'd probably be thrilled with the outcome of buying somewhere right around these levels. So anyway, guys, we'll try to do a much better job of getting a video up for you this week. The week after that, I know the kids will be here, and then right after that, the contractors will be there. So it's going to be a little crazy around here for a few weeks, but we'll try to stay in touch and drop the videos out so that you've got them. In the meantime, have a fantastic holiday shortened week, and absolutely, we should be able to get on here and talk to you either Friday or Monday. Have a great week, everybody, and thanks for spending some time with me.